But today we've got you here, John, to put on that economist hat, put on that Taylor Rule hat, and let's start by looking at inflation. Where is inflation compared to where it was? Is it anywhere near low enough or getting low enough for the Fed to say, oh, we can do 50 instead of 75, we can slow down?
It's not low enough. Remember, the target is 2%. It's well above 2%. I think the fact that the Fed is saying they do 50 rather than 75 is probably baked into the markets at this point. But they might have to later, more later. And that's the question. I think there's a celebration. Well, inflation is down a little bit, but it's not nearly at the level which the Fed has indicated it needs to be. And that's what is going to be on their minds going forward.
Well, a couple of things to put on the table, and one of them is the Taylor Rule. People apply it very literally in a way, and my understanding is that right now you would say the Taylor Rule suggests that the funds rate has to be at least 6%, and we're expecting to hear from the Fed in terms of the dots, in terms of how restricted they have to get, is something more like 5%. So they're going to fall short?
Yes, but they have fallen short for quite a while, so it's not new. I think they'll catch up. Like best guess, we could have extra good news on inflation, but assuming we don't, then they have to indicate that they will raise a little bit. It could be 5-6% before we're done. And I think that if it's done in a deliberative way, in a way which the markets understand, needn't have the contractionary effect that so many people are worrying about. And I think this is, again, deliberative, announced. That's the advantage of a rule or a strategy, which, of course, is part of the Federal Reserve's publications. That'll make a big difference.
So are you concerned when you hear the Fed talking about a soft landing and the possibility they can still engineer a soft landing? A lot of people are concerned because they see the Fed keeping, they're watching on the inflation and wanting to come down, but they've got an eye, looking in the other direction was let's make sure we don't get too contractionary and put too much pressure on the economy.
There's always this debate about too contractionary versus contractionary enough. I think the fear still is with inflation rate well above 2, that it will not come down as much as people hope. We're lucky. We could be good. But in the meantime, it's safer. It's main history. It's thinking about history. And that's the idea. But again, if it's done in an announced way, in a way that people understand, it needn't have this contractionary effect. Wages will have to come down a little bit more than they are anticipated to be. Prices as well, and that's the key. That's the ability of the Fed to make this change.
Well, another rule of thumb that has come down from the past few decades is you're not going to get this kind of inflation down until you bring the federal funds rate well above the inflation rate. Is that a metric you think we need to see as well?
It could be. We don't know yet. I think the hope is the inflation rate will come down a bit so that it's easier to get the funds rate above the inflation rate. It's not above it now, that's for sure. The inflation rate, 7%, is the most recent number. And I think it's hopeful that it will come down. But the main thing is we have to contain the inflation. And to contain the inflation means having a monetary policy that's appropriate for that. It's preventing the wage price spiral from beginning. That's really a danger that people should be concerned about. And we can avoid that if the Fed takes the actions. And I think they're going to begin to do that tomorrow or the next day. And we'll see how that works.
And John, then it's a big communication problem then for Jay Powell. A 7% inflation print can let equities roar, rip higher. The dollar drops substantially. I'm just wondering, how difficult should Jay Powell be open to even saying that 25 basis points in February is possible? Should he bring that up in the press conference, or does that actually just loosen financial conditions further?
I don't think he should bring that up. It's really hard to tell. If it's 50 basis points at this decision, then don't lead on it's 25 or 75 or another 50. It depends. The idea of monetary policies, it depends on what's happening to inflation, what's happening to the real economy. We hope we don't have another downturn. And we can avoid that if, in fact, the Fed says, look, if inflation picks up, we will take action. And then it will occur in a smoother way. And that's, well, the way it should happen.
Is it appropriate for the Fed to slow down the pace of rate hikes right now? They talk about, the argument seems to be, well, because of leads and lags of monetary policy, let's slow down, let's get to a certain level and pause. We make sure that we're on the right path. On the other hand, leads and lags work in the other direction too. If they pause now or not, slow down and then pause now too quickly, aren't they perhaps doing that at a time, not seeing when they get down the road, hey, I guess we shouldn't have slowed down when we did. We should have made sure we stayed on an aggressive path, kept the markets knowing we were not done and not going to be done for a while, and really stress that point.
That's exactly the way to think about it, Kathleen. I think that we could learn from history. The Fed got well behind the curve in the 70s, and Arthur Burns was the chair. He accepted wage and price controls in Nixon. It didn't work out. We don't want to have that situation. The inflation rate increase has been over a shorter period of time. It's maybe 18 months, not 7 years or 8 years as it was in the 70s. So we can do this if the Fed is determined, if the people are supportive of the Fed, if they realize this is the best way to get the inflation down. It's not by waiting and dilly-dallying. It's really by taking the action right now.
There's some voices calling now for the Fed to not wait until 2025 to do a review of the new framework which said we are not going to start raising rates until inflation is above 2% and rising, until we reach maximum employment, which they never really defined. Not preemptive, waiting to see what happened. Is that part of the reason we got to this high level inflation that we have?
It may be the reason. There's no question the Fed was behind the curve, and many people, including myself, have said that. But the question is, what do you do now? And I think the Fed needs to take the action. It needs to do it in a gradual, announced way. What I think will happen as a result of this episode, there'll be more emphasis on the Fed's reporting, discussing, announcing. And after all, it publishes the Taylor rule in this report. It's the most recent report has it in there, and so they need to pay attention to that. And I think the more that they do, the better the policy will be.
John, David here. I'm wondering, when we're trying to come up with scenarios, the Fed itself, yourself as well, one of the goalposts or landmarks is 2% inflation, long-term target. If we're entering something new, do you think the Fed needs to rethink that 2% target? Is that almost something that might be entering a new stage as well?
Well, that might be happening. There's talk about that in the press. I think that would be a mistake. The 2% target didn't originally come from the Fed. The Fed adopted it, and that's worked pretty well. I think that deviating from that for 3% or 4% would make people worry. What are they doing? Did they lose track of what they're supposed to do with monetary policy? And we always have had a trade-off. There's always been this discussion. 2% is glued in, and we should take very seriously the idea of raising that. Used to be was too high, 1%, 1.5%. But I think it's a mistake to raise that at this point, even though there's discussion about doing that.
John, once the Fed gets to a restrictive rate, if it's 5%, 6%, even higher, how long will it have to keep it there? What does history tell us? What does your analysis tell us?
Well, I don't think it needs to be as long as history, because this is a relatively recent thing. Say a year and a half, inflation wasn't high a year and a half or 2 years ago. That's unlike the 70s, where it took almost 12 years before inflation picked up. So this is different. This is a situation where if the Fed signals that it doesn't want inflation to be this high, it wants inflation to be 2%, it will take the actions necessary, then wages and prices will adjust with relatively costless actions on the economy. And that's the hope. I think that can occur if the Fed indicates what it's doing, telegraphs as much as possible as it can that it's doing.
I can't resist asking a question about China, John. You're on Bloomberg Markets Asia. The reopening has started. People are upping their forecast for growth. What do you expect to see from China now? And globally, what does this mean for the economy? Because that's something that also ultimately affects Fed policy.
There's no question. The world is different than it was 30 years ago. It's more interconnected. The decisions in Europe, the decisions in China are in fact, one of the reasons this European Central Bank is behind is because of the Fed. And so it's connected. I think the Fed, in some sense, has a bigger role in global inflation. And central banks, maybe even the Central Bank of China, looks at the decisions of the Fed. It's the exchange rate. It's other things that matter, and they need to take that into account. So I would hope that this becomes a global issue with respect to Europe and China, and we don't have a repeat of the terrible situation of high inflation and eventually high employment that we had earlier in our history.